Our three-part outline is this. We're going to dispel the myths first. We're going to tell the academic story of investing. And with that little comment card in front of you, we'll give you an opportunity, if you haven't taken me up on it, to increase or to achieve peace of mind with respect to your investments as well. So we'll do that as our outline. First, we're going to dispel some myths. And definitions are always very important. So we'll start with a definition even of the word myth. A myth is a story that we make up to try to explain the phenomenon that we don't have information or science behind. I always give the example of the Earth being the center of the universe. It was for centuries. Galileo proved that it wasn't finally with prisms and mirrors. But for a long time, because we saw the sun rising over here and setting over there, and I didn't feel like I moved. Obviously, the sun was moving. I was here stationary, right? And that was the information we had. And so, obviously, we are in the center of the universe. Everything revolves around us. It's what we also want to believe, right? So it's not hard to believe something when it seems as though the facts support what feels right to us as well. And it just doesn't happen to always be true. And in investing, when I talk to young people too, I had a lot of young people here between the holidays. A lot of my clients' children were here. We were talking about investing, and we talked about belief. And it's not just believing that's important. It's what you believe in. Because you can believe something really, really strongly that doesn't work, and it doesn't make it work just because you believe it. So we want to talk about believing something that actually works, and we're going to talk about what works and what doesn't work in investing. So these are the four myths about investing that I want to debunk with you. I'll first talk about what they are, and as we go through each one of them, I'll talk about how they match up to the facts. I often travel. I give this example a lot. And when I travel, I sit next to somebody on a plane. And when you sit next to someone on a plane, you do small talk. And what do you talk about? You talk about your kids. And I've got 10 of those, so that usually takes a while. And then we talk about what we do for a living. And just about the time I start to talk about what I do for a living, they start peppering questions at me. Normally it's, what do you think about Google's new deal? What's Google selling? Is their stock going to go up? Or do you know of a good stock that I should buy? And I generally say, I don't know. I have no idea. And they'll kind of shake that one off, and they'll go into maybe a mutual fund. Maybe I'm a mutual fund guy. So tell me, is there a mutual fund that's done well in the past? And I kind of shake my head at that too. I say, there might be. Probably there is. It's not all that relevant. They'll talk about the market in general. If they have the guts, they'll come back in for another question, and they'll ask me about the market. Should I be in the market or out of the market? It's a new year. I was thinking, last year, these gains or these losses, should I come in the market this next 12-month period? And I'll say, I definitely don't know the answer to that question. That's a good one. That's a good question. And if they have the guts, they'll say, what is it that you said you did again? What you said you were an investment advisor, and you don't know what a good stock is or a good mutual fund is or whether or not I should be out of the market or in the market. And that really is going to be explained to you in the next 20 or 30 minutes. The idea that we could know something in advance is really the main point of investing academically. The answer to that obviously is no. And all of these investing myths, and maybe what you've thought about investing up until now, all of those things presuppose the idea that someone, if it isn't you, could know something in advance of it happening. And we'll look at each one of these in that light. So we're going to look at stock selection first. And I think we're getting to maybe in your book that gives a definition of stock selection, so you can follow along there. Stock selection is good. We want to buy stocks. We own stocks. We own 13,000 of them. Stock selection is choosing stocks based on a belief that they will do well in the future. Hey, Liz. We have the book, How to Win with Capitalism. Can you get me the Myths book? The Myths booklet. We have the book, How to Win with Capitalism. Which was the last seminar we did.
Some have the right.
So the one we're looking for is Separating Myths from Truth. And if you have that's a really good presentation. We could just flip right to that one, and I could give that one. Although I gave it last time, so I'm going to skip that and have Liz get the Myths one. She'll get you a book. Just kind of hold it off to the side. We won't get to where you need to write anything down yet. Choosing stocks based on a belief that they'll do well in the future. The myth here is that advisors, or you, or me, or mutual fund managers can consistently and predictably add value to your portfolio by choosing stocks better than the market could, or better than another person, by individual stock selection. Okay, that's the myth. And I want to show you that that's a myth. And this isn't in your book yet either, but it's a long, large chart that starts in 1923 and ends here in the last set of defined numbers we have, 2013. 2014 numbers will be out soon, but we don't have them yet. And it's a chart that shows us every year how many mutual funds we have to choose from, and in that year how many new funds were born and how many funds were killed. Okay, so you get each line there. In 1923 we had one fund. This was the first mutual fund in the United States. Prior to that you could own stocks, but in 1923 you could own a mutual fund of stocks that someone was managing. And every year for the next 3-4 decades you saw stock mutual funds being added to the list. And even through the difficult 1930s, you had no dead mutual funds here. You can see that. None were killed. And then in 1961, a lot of jumping jacks in the market in 1961, a bunch of mutual funds were killed, 33 of them. And then it started to become commonplace that some years, as many funds as were born, the same number or more were killed, oftentimes more. There's probably a little pent-up demand for killing mutual funds there, and now it became vogue. You could do it. The mutual funds started to die sometimes as often or as in larger numbers as the new funds coming in. You go all the way through this 80-some years, almost 90-some years of data. Is it 90 years of data? And you have a total now of 30,586 mutual funds to choose from. This is far more than the number of stocks you could even choose from. So the combination of stocks exceeds the number of stocks. The total born during this period was 54,000, and the total number killed is 23,000 and change. So the question really is, if you're looking at a prospectus and it's a mutual fund company selling you a set of mutual funds, and they're saying, here is the performance of all of our mutual funds, which funds end up in that prospectus list? Is it all the funds that were in this list? It's not. It's everything that currently exists. So if a mutual fund company does not like the numbers on 4 or 5 of their mutual funds, and it doesn't present their case well, they have a very simple decision they can make. Just kill them. And now their prospectus looks better because they can eliminate all of that information from the data. But the data doesn't go away, because there's a little organization in Chicago called the Center for Research in Stock Pricing, Securities Pricing, here, CRSP we call it, and they have kept all that data. And so we went back and put all that data into the numbers. And what we found was the worst 200 dead mutual funds had a relatively high negative rate of return per annum, per year, and that information was no longer being found in anything that you were reading with respect to your decision making to buy a mutual fund from a certain company or a fund family of any kind. All the information's gone. It doesn't have to be there by law. It's a dead mutual fund. It's a closed company. The company no longer exists. But the information is still relevant, wouldn't you agree? To a company's ability to make or not make money, right? In another presentation that we do, we analyze mutual fund families. So I won't name any names here tonight. We don't need to do that. But some of the major fund families, the fund family that has the most mutual funds has 1,179 different mutual funds you could choose from that one fund family. 1,100. Now, if they knew what was going to happen in the future, how many mutual funds would they need to have? One-ish. Unless you wanted to be more conservative, maybe 2 or 3 or 4. You could probably get it done with 7 or 8 total mutual fund combinations, right? But the fact is they don't. And so they're looking for enough to build their prospectus for next year after they kill the ones that don't work. And you look at how many were killed here in the last number of years. The dead mutual funds are in the 1,500s, 2,600 here. The dead mutual funds oftentimes exceed the new mutual funds coming in. But we put all that information back in, and you end up with this graph. Now we're going to do a lot of graphs. This one's in your book, so I want you to follow along. And there's a little saying that my brother always uses that I like. It says, figures never lie, but liars figure. So I want you to think about the figures I'm giving you, because we can make figures say a lot of things. What we want to do in this seminar, and the whole topic tonight, is give you what we can construe to be the most logical and best information to arrive at the truth. That's our aim at this, and I want you to evaluate me in that way. So what we did is we looked at, in this case, all U.S. equity mutual funds. Now, this would be only the United States. It would be only stocks, not bonds, and it would be mutual funds, not stocks, okay? So we're looking at mutual funds in the U.S., stocks only, not bonds. So it's going to be more aggressive, right? No bonds to lessen the aggressive load. There's going to be some big ups and downs. And here we have the graph explanation. In purple, you have the S&P 500. This is the 500 largest U.S. companies only. Everyone's heard of the S&P 500? Heard about it tonight. It went up 2 points today. Go market, right? Little by little. And then we have the CRSP market. This would be the entire market of stocks that you could have owned. Every company you possibly could have owned in the United States. Micro cap, small cap, mid cap, large, value growth, everything you possibly could have owned would have been in the CRSP market. And then you look at the average of all U.S. mutual funds. Born, dead, living, no longer living, on life support, all the mutual funds you can think of that have ever existed during this period, 1973, all the way through to the end, 2013, where there would have been 30,000 left, right? And you look at the returns from all of the equity mutual funds, and if you put $100,000 in the fund in 1973, you end up with $2.7 million in the average of all mutual funds at the end of that period. And if you had simply put your money in the CRSP market, the entire market, or the U.S. large company market, you would have had $2 million more. $2.3 million is the money lost to active stock picking. When you go back and you get all of the information, because remember, I'm looking at all of the U.S. mutual funds that own stocks only, and comparing them to only stocks in the entire market. Now, granted, there are some costs to investing, but an index fund is pretty inexpensive to own. You can own the S&P 500 for almost nothing, even if you didn't want to be diversified. And you could take home most of that $4.7 million over that 40-some year period of time. Compared to active stock picking, which is the general mode of operation of the mutual funds that you can choose from out of those 30,000 mutual funds. There's another way to look at this, and that is to look at all mutual funds. Now I've added international, I've added bonds. So you'd imagine that the average of all mutual funds would be giving a less rate of return because you're integrating in those bond funds, okay, the less aggressive funds. And $100,000 during the same period of time would have grown to $1.4 million. Our conservative mix of assets would have grown money to $33 million, and the aggressive mix of assets would have grown money to $15 million. I'm going to show you particularly in the second seminar tonight why that's true, what components are here that are not here, and certainly not here. But the main difference between the investment philosophy supporting this number and the investment philosophy supporting these numbers is the activity of picking stocks and bonds based on a belief in the short term that one stock might outperform another. And so you want to avoid this idea of stock picking. A manager's ability to pick stocks in the past doesn't have a correlation, as we'll see with this next myth. So I heard that information about 10 years ago, 12 years ago now, and I was noticing in my mutual funds that my mutual funds weren't necessarily performing. I started in 1994 as an investor when I became employed for the first time after college, 20 years ago. And I went through 95, 96, 97, 98, 99, and then unfortunately 2000 and 2001 and 2002 as an investor, just like many of you did. And I used mutual funds. And I used mutual funds that had done well because I don't want to get negative 79%. So I'm not going to use the losers, I'm going to use the winners. Well, how do you find the winners? You find the winners based on a track record. And the track record investing definition is that we use the performance history of a certain mutual fund or set of funds to determine which fund would be a good investment for me in the future. What else do we have to evaluate a mutual fund if we're looking to find the best ones than their past performance, right? If you're going to hire a football coach, do you hire one that has lost the last 45 games? You don't. You hire Urban Meyer, right? Or Mark D'Antonio. You hire the ones that win a lot. So this is the track record. It's maybe a good indication of how to hire a football coach. I'll tell you it's probably not as good of an indication as to whether or not you should hire a mutual fund manager. Because the myth in this is finding the funds that did well in the past, fund by fund, is not a reliable method of finding funds that do well in the future. And we'll show you that here as well. This should be in your book. You might have to fill this in if you want to take these numbers home, but I'll go slow. So we look at 10-year sections of time. And I've been doing this formally for around 10 years, plus or minus. And every 10 years, we drop a year and pick up a year on this analysis. So we end 20 years from beginning, which is 2013. And what I'm trying to do is show you a 10-year period of time that might have been relevant to a set of investments that I would have chosen prior to the last 10 years. Okay, so in other words, it's 2004, and I'm trying to determine which would be a good set of mutual funds for me to buy in 2004. Make sense? And in order to do that based on track records, I need information from the previous 5 or 10 years, right? So if I'm sitting here 2004 and I'm looking to buy mutual funds, I need the previous 10 years information. And so I'm looking for the very best. I'm looking for the winners from the last 10 years, and I found them. 30 of the top U.S. mutual funds back in 2003. There were probably 20,000 to choose from back then. There are 30,000 today. And the top 30 U.S. mutual funds did over 17% rate of return. The S&P 500 did 11. You remember that CRIS market, the entire market, 1 through 10, small to large, did around 10.73, so the S&P 500 and CRIS market were there. And the average of all U.S. equity funds underperformed the market again, as you'd imagine. They always do. But these top 30 did not underperform. So do I want to choose a mutual fund out of this list of 19,970? No, they're losers, right? I want to choose from the list that almost doubled market returns, because those are the winners. And if I'm going to use track record investing, I'm not going to choose the losers. But the question isn't which 30 funds did the best from 2004 to 2013 after I've purchased them, is it? The question is, how did the list do that I chose to purchase from? Because I didn't have the 2004 to 2013 list in 2004. Oddly, they don't publish that in 2004, right? You'd think they should, based on the claims that they make and the killing of funds that they put in front of the firing squad every year, but they don't, and so I have to choose from this list. But here's how they did next. That winning list performed a little less than the S&P 500, which I could have owned for almost free. And if I'd have owned a diversified fund with small companies in it, I would have done just a little bit better. And the top 30 for one 10-year period underperformed the average of all for the next 10-year period. And they cost more. So does track record investing work? It doesn't. I'll show you another one. These are 5-year periods. In 04 to 08, the top 30 did positive, and you remember 04 to 08. 08 was the big negative, right? That was the big decline. It was a big enough decline to cause the entire market to be negative annually for that entire 5-year period of time on an average of 2%. So you have 30 funds that were positive 4.5, or you could stick with the market that for the previous 5 years did negative 2. That's a difficult decision to make as an investor. You're looking at winners, and now it appears the entire market was a loser, right? Now, I choose from this top 30 list, maybe I choose 15 mutual funds and I build my portfolio, or 10, or 5, or I put it all in the top 1. This mutual fund list, on average, did 6.24. The average of all U.S. funds did 18, and the S&P 500 did 17.94. The total market beat all of them. We're making a case for no choosing based on track records, no stock picking, simply owning the market and being disciplined throughout the entire period, start to finish, so that we're not subjecting ourselves to this kind of return. They simply did the best, and they did about the same the next period, and we chose them because they beat the market. We thought they knew something. When 30 out of 30,000 mutual funds, the fact is they probably just got lucky. Frankly, out of 30,000 mutual funds, it's a statistical certainty that 30 or 50 of them would beat the market. It's just probably closer to a guarantee, if you understand statistics, that 20, 30, 40 mutual funds out of 30,000 are going to beat the market. We just don't know which ones will do it in front. And so we don't want to build our portfolios that way. A manager's ability to pick funds in the past has no correlation. Compliance says that I have to say little to no correlation. It's really no real correlation between their past performance and whether or not they can pick funds that did well in the future again. So that is mutual fund investing based on track records. Frustratingly, though, track records is what you get, right? If you've opened your 401k statement recently and they show you the funds that you own, what do they show you directly to the left of those funds? The 1 year, 5 year, 10 year since inception, and maybe some cost information, which isn't even all the costs that you're gonna see. It's all the information that they have to give you, and so that's what they do give you. Make sense? So last one, in the picking area, the market timing area, any attempt to alter or change a mix of assets based on a prediction about the future. And the myth is that money managers are able to utilize market timing techniques to add value to your portfolio by getting in and out of the market and get you non-risk related returns by choosing the right periods. DALBAR is an organization that you can research, and this is listed in your book. You could circle the words DALBAR or the word DALBAR, D-A-L-B-A-R. It's a company that tracks investor results. Now, previous slides, I've been going through mutual fund results. But you recognize that you could buy a mutual fund in January, you could sell it in February, you could buy it again in September, and you could sell it at the end of the year. And the mutual fund may have shown one set of returns, but you could have gotten a different set of returns, correct? So you can be in and out of mutual funds and not actually get that mutual fund's rate of return because you were in and out. Well, it's that in and out that is market timing. You can do it as investors. Mutual fund managers and advisors actually do it. Advisors are probably bigger offenders than you are as a whole. And it's probably the nervousness and anxiety that advisors have about your emotions that cause us to be worse offenders than you. And that's what we have to try to mitigate and eliminate. But if you look at the S&P 500 index again, over a 30-year period of time, 11.10% rate of return. Now this is including everything that you've seen. Now Black Monday was in 87, 2000, 2001, the tech bubble bursting is in here. You've got 2008's housing crisis. All of it's in there, and the S&P 500 still chugs along at about 11%, and the average equity investor gets under 4. We call this the investor behavior gap. So if the S&P 500 or the market is getting 11 and the investor is getting 4, what is it? Why is the investor not getting 11? There isn't that much cost, but cost is one item, right? We'll get to cost next. But it's got to be behavior. Someone doesn't behave by simply owning the market from the beginning to end, and it's usually you or me or a mutual fund manager. Someone's not doing it. Market timing is extremely difficult. If you just invested $10,000 in 93 and held it for 20 years, that'd be 5,040 total trading days. Okay, markets are closed on Sundays, closed on Saturdays, closed a lot of holidays, closed yesterday, and 5,040 total trading days during this period of time, 20 years. And if you'd have held the S&P 500 during that entire 20-year period of time, your 10,000 would have grown to nearly 55,000. Now, who wouldn't have killed for returns like that in whatever you had invested back in 1993? Most of us, probably. And many of us didn't get it. If you were out of the market for the 10 best days out of those 5,000, so you take All the days out of the 5,000, you rank them from the best return day to the worst. You take the top 10 and you eliminate them from your returns. Can't possibly happen. No one can get that unlucky from trading in and out on those days, right? But just making a point. The top 10 days alone cut your total return in half. Now what this illustrates, again, is not, hey, how do I get that unlucky? It's illustrating how volatile the market is. The returns are so fast and furious when they come, and the ups and downs are so spontaneous and random feeling that there's no way we could predict them in any fashion consistently enough to maintain the market's kind of investments. You miss the top 30 days and you've made, I don't know, $100 or something during the period. And so market timing is extremely difficult because the market is so volatile and so unpredictable and random feeling that it's impossible to try to market time to either reduce losses by getting out before crashes or make extra money by getting into right sectors. And what I'm talking about here is exactly the topic we're going to be bringing in after dinner. It's what's been happening in the last year, this idea of market timing. Don't be fooled by tactical asset allocation. Asset allocation is a good couple of words strung together to describe what we ought to be doing. We ought to allocate our assets among different classes. But the word tactical, when you see something like that, or the word strategic, or the word flexible, you'll hear those words a lot. Flexible, strategic, tactical. They usually mean that the manager of the money wants flexibility to do what they want to outside of an academic set of standards. I get emails 2-3 times a day from Financial Planner Magazine or Investing Today or whatever, just because I sign up for these news feeds, and I hear about tactical asset allocation 5-6 times a week. And it's big right now. They want you to know that they're being tactical. They're looking at what happened in the last year and they're going to tactically move you around. And that's what we're going to talk about later on tonight. Beware of that, because it's more difficult, maybe even, should I be in the market or out of it? In or out, but should I be in small or large or international or bonds? Or you start market timing with multiple different asset classes, and the speed at which you can lose your money just increases, and the numbers don't get any better. Charlie Ellis confirms the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. It's impressively negative how badly they are at market timing with your money and getting you in and out at the right time. He's worth reading. He writes the book, The Loser's Game. Winning the Loser's Game is a separate book, not investment policy, Winning the Loser's Game, but Winning the Loser's Game. If you want to look up a good book on this style of investing, on academic investing, Charlie Ellis is easy to understand. Myth 4, cost of investing. Fees incurred by investors to buy, sell, own mutual funds and stocks. And the myth here is what you don't see can't hurt you. And that is not true. What you don't see can hurt you. You have bid and ask spread fees, mutual fund expenses. We'll just talk about one of these. This would be one area where if you're new to this and you haven't had your investments analyzed, I would encourage you to have them analyzed so that we can see and show you where the costs are that you're not seeing. Because the costs are there, and they do come away from your return. And here's an example of one. On every day that a stock can be bought or sold, you have two different prices for that stock. You have a buy price and a sell price, a bid and ask. And the spread between those goes to a market maker, which I think is a good system. It's abused like any good system is. But when you want to sell some of your stock, you couldn't just sell it to me. Heidi and I are talking about IBM today. I happen to want to sell it, maybe because I need to buy a car, and you are looking to make investments, and you know I own IBM, and you want to own IBM, so you say, hey, can I just buy some off you? And we can't do that. Legally, we can't make that buy-sell trade. It has to go through a market maker. That way it's a known transaction. It's all legal. FINRA requires this, the government requires this, and it's probably a good system that it's all required to be done that way. We actually have good stock pricing models now that we can track, but that costs some money, and that spread is there. And if I buy on a given day and Heidi sells in the same market, we each exchange 100 shares, we're exchanging it. Did I see a 50-cent cost in my buy? No, I just owned a company for $50 a pop. Did the seller experience a 50-cent cost that showed up on their statement? No, it just showed up as a sell price, right? So it comes out of the middle. But if you're working with a mutual fund manager that has a turnover rate inside their mutual fund, this is a new term, that is a high turnover rate. So if we're working with a mutual fund manager that is trying to beat the market by buying and selling stocks, they're going to be incurring a lot of these buy and sell charges inside your mutual fund, and you're going to experience the loss of that without ever seeing it. It's just going to be the difference. Now, the contention is that mutual fund manager is making money by doing that. They're making a good trade. But what we've seen in stock picking and mutual fund track record investing is that the numbers aren't on their side with that. So what we know is that all of that buying and selling costs money, and it'd be fine if it made money for you in a predictable fashion, but it doesn't, because even if we choose the very best managers who made money for their clients, after they did so, they don't necessarily make money the next period. And so this is a cost that simply gets incurred, and we never have an association as to whether or not it's actually retained for us or given us a positive return as a result. The larger the company, the lesser the cost. So GM is less to trade than Buffalo Wild Wings, small company down here. The smaller the company, the higher the cost. This is why you'll mostly see in 401k portfolios large company funds, because they trade them like crazy and they don't cost as much to trade, which means they don't need to outdo the market, because so this explains bid-ask spread, which I talked about. Charlie Ellis says the key question under the new rules of the game is this: how much better must the active manager be than the market in order to get the market return and then beat it over top of the cost that they're incurring in their buying and selling and their expenses? He says the answer is daunting as he does the research. We've seen mutual funds that have turnover cost estimates in the neighborhood of 3% per year. So you have your expense ratios, you have the commissions you paid to buy the mutual funds, and then inside, you haven't seen it necessarily, but anywhere from 0.5 or 1 to 3% trading fees inside the mutual fund. How much better does the manager need to be than the market? Now we know that they can't beat the market already, and the fact that they're convincing you that they can with some past data, it's simply a way that they're incurring extra revenue for themselves. So far, the myths: stock selection, track record investing, market timing, costs of investing. And if I stopped there, that would be rather depressing. Sometimes even for folks who have been with me for a while, it's a little depressing, thinking, wow, that's right, that's where it's at. But there is an approach that can remove those aspects of investing. And that approach is Mattson's free market portfolio theory. We'll go through that quickly here before dinner. This is an investment approach grounded in academic research over 50 plus years now, really since 1952. And it's a disciplined approach that focuses on capturing market returns rather than beating the market. So you'll hear the words that we're using. We're going to capture market returns, we want to reduce fees, and we want to ask you to be disciplined throughout many market types. And there are three components to this theory. There's the philosophical component first, then there's the theoretical component, which is the modern portfolio theory, and then there's the on the ground, where do returns come from. So we're just going to deal with it in that order. We're going to go philosophical first, pricing models, then theoretical, and then the three-factor model. We'll go through it in these three, and you can follow along in your book again and fill in as we go through. All right, these are the guys we are standing on. Merton Miller, Harry Markowitz, in 1990 won the Nobel Prize for their work. Harry wrote the book his paper in 1952 on his theory. His theory was pretty much proven right 38 years later in 1990, after the computers were strong enough and the data was large enough to be able to determine that yes, what he was saying was true. I'll explain that. Rex Sinkfeld, I've heard him speak one time. He's now working with the three people who marketed Anheuser-Busch to 50% market share in the United States. He's working with those same three marketing geniuses to try to convince the United States that a flat tax would be better than an income tax. So you can keep Rex Sinkfeld in your prayers. How about that? We'd all like him to win. He's a dynamic, fun speaker. He's the reason we have S&P and other U.S. data back to 1926. He's the one that found it, authenticated it, and we had it to 1971. But he's the reason we have it back to 1976 in a way that nobody could argue with. Single-handedly, he did that. So he has contributed. You do that, you can write your ticket at this point. Roger Ibbotson, we know his name He has worked together with Rex. Eugene Fama just won the Nobel Prize for the fourth factor, and Ken French. These two guys are building that lower level, that three-factor model, and the on-the-ground level of research. If Eugene Fama says, guys, there's a premium to be gained here, we generally will read his stuff and then add that to our portfolios. He's who we're following, and his group at the University of Chicago. He's still there. I think he's in his late 70s, still doing research in this field. So these are the people we're watching and looking at. You can ask me for their names if they're not in the book. I think they might be, and I can get them to you if you want to read about those. Free markets work. So first, the philosophical level. At any given point in time, the actual price of a company is the best indication of that company's value. Now, this may seem basic and obvious to you, but think about it in the context of real world. You're driving home, it's 5:15, and on the way home you hear the news on the hour or on the quarter hour, right? And they say, Wells Fargo has just been upgraded to a buy, or Bank of America has just been downgraded to a sell. What are they saying? What they're saying is that we think Wells Fargo is underpriced right now. If Wells Fargo has been upgraded to a buy, we think you all ought to get in, right? Buy it. It's upgraded. It means the current price today does not reflect everything that it has as potential. It should be priced higher, they're saying. Is that true? Can we know that? The potential belief, free markets fail. If markets fail to price goods and services efficiently, right, it's possible then for some individuals to identify in advance which companies or sectors might be underpriced or overpriced. Then these underpriced or overpriced sectors or companies could be forecasted and predicted. That information could be used by a money manager to increase your returns on, and mitigate losses by taking advantage of these mispricings, right? And people with this view should utilize traditional investment methods. How would we capture that kind of stuff? Well, we would look at managers' ability to have done it in the past. Right? We'd have to go to their track record to find out how well they've been able to do that. Alternate belief that free markets work, then the free market is the best determinant of the value of a company or a price. Supply and demand sets that price. All available information is factored into a price. Only new and unknowable information could change the price in the future. And the randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. So there's a philosophical question here that's at the base of it. Do you think someone can predict the future about the price of a stock or a mutual fund, or don't you? I'm asking folks that come work with us to just say, in basic form, and in fact, if on the higher level philosophical, you said, Evan, I don't really care to understand all the minutia of this, but I think that's what I think. Then we would have a basis for doing business together, because you're not going to look at me and say, Evan, I think you should be able to evaluate a company and know ahead of time whether it's going to outperform the average company, right? Only new and unknowable information can change the future, and you'd utilize free market investment strategies that I'm about to show you. Because beliefs dictate action. If free markets work to set prices, then we need to capture returns, eliminating those traditional strategies, utilize asset class or structured funds, diversifying prudently, identify your risk tolerance up front, that's the most important job that you have, and work with a coach who shares your belief. But if markets fail, focus on active management, pursue traditional investment strategies, stock picking, track record investing, market timing. Stay connected to multiple sources of financial information. Read as much market information as you can. Or don't do that and work with a professional who you expect will do that for you and get you out of the market in time or into opportunistic sectors in time and help you win, right? That's the decision. That's the primary decision that investors working with us really ought to make. Then we move to that theoretical level. So if we've made that decision, then we look at it and say, okay, the theory behind, or the theory that coincides with that, is modern portfolio theory. Because now what we're looking to do is have Harry Markowitz research inform our investing. And he, again, won the Nobel Prize for what he wrote in 1952. And essentially he showed us this, that you could build a portfolio that gets the same return as the S&P 500 with less risk, or by diversifying, with similar risk, you can get a much better return. or some combination of that. But he said diversification works to either reduce risk or increase return depending on where you're sitting in relation to your need for the money. Sometimes that's your age, sometimes that's something different. And what he found was that asset allocation was the primary component of return. So it wasn't stock selection, other factors, market timing, it was asset allocation. It was where you're invested primarily. That's what drove this. And what he did is he said, we know that certain assets go up while other assets go down. Now, I'm going to ask you to remember this picture for the next presentation, because what I'm showing you here with a red and blue that almost perfectly symmetrically go like this, the market has done this for us beautifully, and we're experiencing it right now, and I know you're all excited for the after dinner. You're not going to be able to eat even because you're that excited. But the market's doing this perfectly and beautifully right now, and I'm going to show it to you in market form in 35 to 40 short minutes. So we look at owning investment A, which is going up, at the same time that we own investment B, which is going down, and we don't have to experience either volatility, either set of volatility of either fund. We can experience something much smoother and still end up in the same place. Make sense in picture form? That's the benefit of diversification. We call this dissimilar price movement or low correlation. If one asset's going up while another one's going down, they're said to have low correlation. Okay? So a simplified example, you take the S&P 500, you're all in. You get a rate of return on average of around 10 over very long periods of time. 43 years, 43 years, is that right? Yep. And a standard deviation of risk number that's pretty high. This just means that it's pretty volatile. It's going to go up and down a lot. You know that because you just experienced it in 2008. But if you sell off 30% of it and buy EFI, which stands for Europe, Australasia, Far East, which is or international large companies, then you have a slightly higher return and a slightly lesser risk. Go even further and add small. We're going to add international small. We increase rate of return further, and we further decrease risk. We've decreased risk by almost 0.5 percentage point, and we increased return by more than 0.5 percentage point. And if you can figure out something that cool, they will also give you the Nobel Prize. That's what Harry Markowitz found. This is what he proved in 1952. In enough theory to get it published, and then 38 years later they actually proved the numbers actually happened. And this is pretty significant when I can show you a way as an investment advisor not to predict the future, but to make the future predictions something you can live with a little bit more easily based on who you are. We don't need to predict the future, and that's what you want really, because you know instinctively that you can't do it. So the last component is where returns come from. And this too will be part of our second seminar next time, so I don't want to go through this too quickly. Factors 1, 2, and 3, market factor, size factor, and value factor. There are, Liz, can you get me a napkin or something? I don't have my eraser here, but maybe just a paper towel or something that I can wipe this off. There are a number of different asset classes that we use. Large companies, small companies, middle-sized companies we stay away from. We have value companies and growth companies, okay? And what we're talking about is where the premiums come from, what the returns are in these various sectors. Equities, stocks, versus T-bills, CDs, or bonds. Equities outperform stocks. They outperform stocks by quite a bit. 7%, 6.5%. They're much riskier than stocks or than T-bills. Stocks have a high standard deviation of risk over long periods of time. Thanks, Liz. And bonds have a low standard deviation of risk. But we get the return for it. So if I showed you a high standard deviation of risk compared to another investment, but there was no premium for it, why would we take the higher standard deviation of risk? We wouldn't. There would be no reason to take the risk if there was no return associated with it. But here we have a return. We get a return for being in equities, which is why almost everyone I meet has some stocks in their portfolio. We want those returns, right? Now, better than just large company stocks, we can increase our returns further by going with small company stocks. And here I've just chosen U.S. small companies. Small companies are riskier than large companies. Small companies have historically provided a higher rate of return also. So again, we have higher standard deviation of risk with small companies, but we also get a premium. It's those premiums that we want to capture. What I'll show you in a few minutes is you don't have to take the average of those standard deviations of risk because of what we showed you in the previous slide. When you put one against the other, one's going up while the other's going down, you can actually have a lower standard deviation of risk by putting these two together. Does that make sense? Because they don't have all their negative years at the same time. Sometimes they do, but they don't always. The third component is value component. This is the price of a stock. You've heard of penny stocks. This isn't a perfect example, but low price stocks are considered value companies. They're a value right now. Homes over the past 5, 6, 7 years have been value. You could buy more home than you could build, right? But there was a time where you could build a home for less than you could buy a home for, and that would have been a growth period. Well, high book to market or high value stocks, where the book value of the company is high compared to the price, they get a better rate of return, value companies do, than growth companies do. Higher standard deviation of risk again, no worries, they offset each other. We're going to take these premiums despite the increase in risk because the premiums are worth it, depending on how you put them together and whether or not you market time. So you put these all together. Free markets work philosophically. Modern portfolio theory in general says that diversification works to offset risk and increase return. And then we go where return is found. We go and find the premiums where we know they are. And you get the free market portfolio theory. And so in the last sections of your book, you can write these in. This is where we normally start. If we take a period, 20, 30, 40 years, we generally find this information to be true. We find that the average equity investor is getting between 3 and 5%, and they're experiencing high volatility along the way. They experience all the negative of 2008, but either because they didn't know what to do or they got bad advice, they're getting an average of 3, 4, 5%, sometimes worse. The first move is to move to the S&P 500 and get away from these negatives here. Get away from the fact that they're constantly changing strategies. Get away from market timing. Get away from stock picking and track record investing. These are the reasons we don't do well. And just get into a market-based fund like the S&P 500 as step one. You can do much better than this, but this is a good first step where your return is around 10 and your standard deviation of risk is 17. Now what we'd like to do is increase return and decrease risk. Increase the amount of money you get at the end and decrease the amount of hills you've got to go up and down to get there, right? Because you'll be much more disciplined the smoother the ride. So if we can do those two things, that'll be good. So we add fixed income. And surprisingly, fixed income, bonds of 40%, only reduces the return by a full percentage point. Now that's quite a bit in compounding terms, but it's not as much as you might think, but it severely decreases the standard deviation of risk. It takes away lots of the ups and downs in your market. Then we want to start to add international. So we split the US and the international in half. We increase return a little bit. We further decrease risk. We add small US, small international. We further increase return. We actually increase risk just a little bit there. Then we bring in value, and we've increased return even further, and we've decreased risk. So we were able to increase return from just that S&P 500 component, from 10.4 to 10.99, nearly 11, and we were able to do it with a third less risk or a third less volatility in the fund through an academic approach to investing. And I'll draw those asset classes here before the beginning of the next session. So this is the free market equity and the free market fixed income and the free market international equity portfolio that we have built. How much of any one of these you own has a lot to do with who you are. Our aggressive fund has only 5% here, has 50% here, and 45% here. And that's where some of you are. Our most conservative asset allocation model has 75% in the fixed income component, and 15% here, and only 10% here. And you still get dangerously close to just achieving that S&P 500 average rate of return with almost no down years. There were 2 down years in the last 40 years in our conservative fund, which is a tremendous place to gather income for your retirement. So I'm going to end with that.